we're jumping straight into Nebius Group today. Everyone is watching the price action, but the real story is the massive capacity expansion leading into next week's earnings.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of GPU clusters and power efficiency, do us a huge favor, subscribe and hit the like button. It helps us keep simplifying this complex market for you.
It really does.
Now, let's talk Nebius, because honestly, looking at the screen this week, it feels like we're standing in the eye of a hurricane.
It is absolutely the topic of the week.
Mm-hmm.
And you're right about that analogy. There's a lot of noise, a lot of wind, and right in the middle, this company is trying to build something massive.
So we are recording this on Wednesday, February 4th, 2026. The company reports next week, February 12th. But if you've been watching the stock, you might be reaching for the antacids.
That's a very polite way of putting it.
It's been let's call it a character building few weeks for investors.
A 30% drawdown is.
Yeah.
Yeah, that's more than character building.
I'm trying to be diplomatic. But yes, a 30% drop. That is a kind of move that makes people panic sell and ask questions later. But the reason we're digging into this today is that when you stop staring at the chart and actually open up the financial reports, the story gets incredibly confusing.
Confusing is the right word.
Because the business seems to be on fire, in a good way.
There's a massive disconnect right now between the sentiment and the actual fundamentals. We're looking at a company that is projecting annual recurring revenue, ARR, to land somewhere between, $750 million and $1 billion by the end of 2025.
Which on its own is a serious business. That puts them in the big leagues.
It does. But that's just base camp. The number that really matters, the one that the whole valuation is pinned on, is where they expect to be heading into 2027.
Okay.
Management is targeting an ARR jump to between $7 and $9 billion.
Okay, just pause for a second. Going from roughly $1 billion to $9 billion in barely 2 years. That doesn't happen. That isn't normal growth. It sounds like a typo in a slide deck.
I know.
How do you mathematically get there?
You don't get there with software sales alone. And
Yeah.
you definitely don't get there by raising prices. You get there through raw industrial capacity expansion. It comes down to two things: clients and hardware velocity.
Hardware velocity. I like that term.
It fits. If you rewind a bit, Nebius started with about 10 core clients. Today, they have over 40.
And these are big names, right? Not just startups.
Right. These are AI-native companies hungry for compute.
Yeah.
But the client list is a lagging indicator. The clients go where the chips are. So the real metric, the leading indicator, is the GPU count.
The engine of the whole thing.
Exactly. They have surged from having roughly 2,000 GPU units to over 35,000 operational units right now.
Wow, that's a huge ramp in a very short time.
It is. But 35,000 is just the warm-up act, the roadmap. The one that justifies that $9 billion revenue target, requires them to scale from that 35,000 up to 240,000 GPUs by 2027.
240,000. That is a staggering amount of compute. That's the size of the clusters that Meta or Google were bragging about just a year or two ago.
Precisely. They are trying to join the heavyweight class in record time.
Okay, but this brings me to the big question. The skepticism. There are a lot of companies buying GPUs right now. Everyone is hoarding NVIDIA chips like they're gold bars.
It feels like a commodity trade, I know.
Yeah. So why is it Nebius just another landlord renting out server space? What's the moat?
That is the single most important question. Because if they are just a landlord, they are in trouble. Landlords eventually get their margins squeezed. Nebius is trying to avoid that trap by building what we call a full-stack moat.
Full stack. We hear that in software all the time. What does it mean when you're talking about physical concrete and wires?
It means total control of the value chain. Think about how most of these other cloud providers operate. They're middlemen. They buy chips from NVIDIA, they rent a hall in a third-party data center.
Like an Equinix or Digital Realty?
Exactly. And they slap some billing software on top. They're dependent on vendors for everything.
So they're basically ticket scalpers for compute power.
A bit harsh, but directionally accurate. Nebius is different. They control the entire stack. They aren't just renting a room. They're designing the hotel, pouring the concrete, and building the furniture inside.
Custom data center design, in-house server design, all of it.
All of it.
Does that actually matter to the customer, though? If I'm an AI startup, do I care who poured the concrete? I just want my model to train fast.
You care about the price and the performance. And that's where the design matters. Because Nebius designs everything themselves. They achieve efficiency metrics that are, frankly, they're hard to believe. We have to talk about PUE.
Okay, let's unpack PUE, power usage effectiveness. What is it, and what's a good score?
PUE is a ratio. It measures how much energy coming into the building is actually used for compute. Ideally, you want a 1.0. That would mean 100% of the power goes to the GPUs.
Which is impossible, right? You need lights, cooling.
Physics demands a tax, yes. You always have waste. The industry average for data centers, and this includes the big guys, hovers around 1.5.
So for every dollar of electricity for compute, you're spending another 50 cents just on cooling and overhead.
That's it. It's a huge overhead.
Okay, so where is Nebius?
They're running at roughly 1.13.
Wow, okay. So they've shaved that waste down to almost nothing.
That puts them in the top 5% globally.
And practically speaking, that means their electricity bill, which has to be their biggest operating cost, is way, way lower than their competitors.
Precisely. And when you're scaling to hundreds of thousands of GPUs, that efficiency translates directly to massive profit margins. Plus, by using their own software, their own designs, they avoid paying third-party licensing fees.
They're not bleeding cash to vendors.
At every step of the process.
Right. It's like the difference between ordering Uber Eats every night and just cooking in your own kitchen. The ingredients, the NVIDIA chips, cost the same, but the overhead kills you.
That is a fantastic analogy. They're cooking at home at industrial scale. But speaking of ingredients, we have to talk about the supplier.
NVIDIA.
The kingmaker. You can have the best data center, but if Jensen Huang doesn't send you the chips, you have an empty warehouse. Nebius has secured partnerships that ensure they get hardware priority. Specifically, the Vera Rubin NVL72 launch.
Ah, the NVL72, the next-gen architecture. Why is that specific model such a big deal?
It isn't just a faster chip, it's a rack-scale system. Imagine 72 GPUs connected so tightly they act as one giant superchip.
Yeah.
But here's the catch. It runs extremely hot. You cannot cool this thing with fans. It needs liquid cooling.
And most data centers aren't built for that. They're built for air conditioning.
Exactly. Retrofitting a legacy data center for liquid cooling is a nightmare. But because of Nebius's custom design approach, they are native to this. They are ready for it.
So being at the front of the line for Vera Rubin is a massive technological edge. They can offer clients the fastest compute on the market before competitors can even plug it in.
It's a speed advantage and a performance advantage, yes.
So, okay, let's recap the bull case. They have efficiency, custom design, VIP pass for new chips, but building all this, it's capital intensive. Are they drowning in debt?
Surprisingly, no. And this is a pillar of the bull case that often gets overlooked because it's just accounting. But their balance sheet is actually very healthy. Net cash flexibility.
More cash than debt.
Yeah.
That is incredibly rare in this space.
It is. They're using a strategy of modular data centers. Instead of trying to build a massive billion-dollar facility all at once.
Which takes years and generates zero revenue until it's done.
Right. They build in chunks.
Yeah.
Modules, like Lego blocks. You build a module, you fill it with GPUs, you start generating revenue from it immediately, and you use that cash to fund the next block.
That's incredibly smart. It de-risks the whole thing.
It really does. They have pre-sold the capacity.
Okay, it sounds almost too smart, which brings me to the other side. If everything is this great, why did the stock drop 30%?
That's the billion-dollar question.
Right. What is the bear case here? What are people so afraid of?
The fear is execution risk. We are entering the show-me phase. The market is looking at that 240,000 GPU target, then looking at the reality of construction in 2026 and asking, can they actually build this fast?
Because a slide deck is one thing. Pouring concrete, getting permits, that's another.
Exactly. And the biggest bottleneck right now isn't money. It's not even demand. The bottleneck is power.
Physics again. It always comes back to physics.
It does. You can have all the NVIDIA chips in the world, but if you can't plug them into a grid that can handle gigawatts of power, they're useless.
And people underestimate this. You don't just plug a data center into a wall socket. You need substations, high voltage lines.
And utility companies are not known for their speed.
Yeah.
So the risk is delays. If Nebius promises a facility will be online in Q2, and the utility says, sorry, 6 more months, they're stuck.
And if they're stuck, that explosive revenue growth gets pushed to the right.
And when you are valued on perfect growth, any delay gets punished severely. That's why we saw that 30% dip. It's the market pricing in the probability of hiccups.
The priced for perfection problem?
Precisely. And they aren't operating in a vacuum. We have to talk competition. If Nebius is delayed, those customers don't just wait around.
They go somewhere else. Who are we talking about? The giants.
The hyperscalers, Google, Microsoft, Amazon, are obviously the gorillas. But the real rival in this niche is someone like CoreWeave. They're moving incredibly fast.
And loyalty is pretty low in this game, isn't it?
Almost non-existent. It is a race for capacity. An AI lab needs to train their model now. They won't wait 6 months for a building to be finished if a competitor has capacity today.
So if Nebius stumbles, CoreWeave swoops in and takes the contract.
It is a pure land grab. The valuation of Nebius depends entirely on perfect execution.
Okay, so a clear picture is forming. On one hand, a highly efficient full-stack machine. On the other, a massive construction project fighting physics and competitors.
High risk, high reward. That sums it up.
So for the listener, with earnings next week, what should they be watching? Let's build out the catalyst calendar.
Well, the date is February 12th. That's the Q4 and fiscal year 2025 report.
Next week, what are we looking for? Just the revenue number.
Revenue is big, of course. Analysts want to see that explosive growth. But I would argue the guidance is infinitely more important.
What they expect to do.
Exactly. Guidance tells us if the trajectory toward that $7 billion mark is still intact. If they lower guidance or sound cautious about 2026, the stock could see another leg down.
And the tech. You mentioned Vera Rubin.
Absolutely. Listen for any updates on the NVL72 launch. That's their edge. If they announce delays getting those chips, that is a red flag. But if they confirm they're on schedule, or even ahead of schedule, that could reverse this whole dip.
And what about the power bottleneck?
100%. Watch for infrastructure milestones. It might sound boring to read about regional AI cloud edge rollouts, but that is where the real information is.
It's not boring if it makes you money.
True. But specifically, look for confirmation of power contracts. Securing power is just as important as securing chips. If they announce they've locked in power for the next phase, that de-risks the bear case significantly.
And I've noticed some interesting movement from the big money, from institutions.
Yes, the institutional flow is very telling. We've seen funds, specifically the Alger Small and Mid-Cap Focus funds, showing significant interest. They've been accumulating during this volatility.
That's the smart money. Why are they buying when others are selling?
They are looking at the 2027 horizon, not the 2026 volatility. It signals confidence in the long-term thesis. If we see that accumulation continue after earnings, it's a very bullish signal.
So the playbook for next week. Watch the guidance, listen for the words Vera Rubin and power contracts, and watch if the big funds keep buying.
That's the strategy.
All right, let's wrap this up. We've covered a lot of ground. It's a high-octane bet on AI infrastructure.
It is. The bull case is compelling. A clear path to $9 billion in revenue, driven by superior engineering and a full-stack model.
And the bear case is that building physical stuff in 2026 is really, really hard. The grid is full, construction takes time, and competitors are ruthless.
And that leads me to a final thought for everyone listening. We talked about that 30% dip. The market punished the stock because of fear of delays. But ask yourself this. Has the fundamental demand for GPU capacity slowed down at all?
Not a bit. If anything, it's speeding up.
Exactly. The demand is insatiable. So every delay in supply just makes the available capacity more valuable. Is the market ignoring the efficiency of Nebius's model just because they're worried about a few months of construction timelines?
That's a great question.
If Nebius can execute, that dip might look like a gift in retrospect. But if is the big operative word.
And that is the lowdown on Nebius Group. A fascinating setup leading into next week. We will certainly be watching February 12th closely.
Definitely. It's going to be an interesting week.
Thanks for tuning in to the Easy Money Show. If this helped you make sense of the chaos, make sure you subscribe so you don't miss the next breakdown. We'll see you next time.